If you're planning to leave Canada, one of the biggest questions keeping you up at night is most likely about your retirement accounts. For example, what happens to the life savings sitting inside your RRSP or RRIF? Do you have to cash it all out before you board that plane? And if you don't, how much is the Canada Revenue Agency going to take when you finally start making withdrawals from your new home abroad? My name is Serge. I'm a certified financial planner, and welcome to our episode 2 of the Nomad Blueprint. In previous weeks, on our first episode, we laid the critical foundation. We talked about how the CRA views your residency status, the difference between a factual resident and a non-resident for tax purposes, and why severing those primary and secondary ties is the most important first step you must take if you want to be viewed as a non-resident for tax purposes. If you missed that video, you can go back into the Nomad sessions or in our channel and watch it, because your residency status dictates everything we are going to talk about today. And today we are focusing on one specific financial pillar, managing your RRSPs and your RRIFs once you are officially a non-resident of Canada. Before we get into the weeds, I want to address that I am a certified financial planner. I am not an accountant, and I am not an international tax accountant. I am researching this cross-border tax information on my own so that I can synthesize it and present it clearly in these sessions. Because of that, I will be adding links to the specific CRA regulations and government sources in the comments section below this video, and I highly encourage you to click those links. Feel free to research this information for yourself, and as always, consult with a qualified professional regarding your specific situation before making any financial decisions. This video is strictly for educational and informational purposes only. So, let's dispel the biggest myth first. You do not have to collapse your accounts when you leave. You can leave the money right where it is, continuing to grow tax deferred within the Canadian tax system. The tax event only triggers when you pull the money out. When you make a withdrawal, non-residents have to pay a tax on amounts that are taxable under Part 13 of the Income Tax Act. The default withholding rate is 25% of the gross payment. And generally, if you are a non-resident, the tax withheld is usually your final tax obligation to Canada on this income. Now, 25% is a significant chunk of your savings, but it is rarely the final word if you plan correctly. This rate can be reduced to a lower rate, or an exemption can be given under the provisions of a bilateral tax treaty between Canada and the other country. How you withdraw the money matters immensely. For example, the default rate is 25% on lump sums for non-residents, but this can be reduced to 15% on periodic pension or RRIF payments under many tax treaties. This means that pulling out a massive lump sum from your RRSP to buy a home overseas might trigger the full 25% withholding tax, whereas converting that RRSP to a RRIF and taking smaller periodic payments could slash that tax rate down to 15%, depending on the specific treaty Canada has with your host country. But what if even 15% is too high? What if your overall global income in a specific year is very low, and if you were still living in Canada, your marginal tax rate would be virtually zero? This is where a special filing option comes into play. A Section 217 election is an optional provision under the Canadian Income Tax Act that allows non-residents receiving certain Canadian-sourced income, like RRSP and RRIF withdrawals, to file a T1 personal tax return instead of accepting Part 13 withholding as their final Canadian tax obligation. By making a Section 217 election, you are taxed at graduated Canadian resident rates and can still claim certain personal credits. The CRA then recalculates the tax using regular marginal tax rates. If the resulting tax is lower than the 25% or the 15% already withheld, you may receive a refund for the excess amount. However, this is not a guaranteed win. The election only makes financial sense when your calculated tax on Canadian-sourced income is lower than the Part 13 withholding tax already remitted. If the calculated tax is higher, the election results in additional tax owing rather than a refund. If you want to prevent the CRA from taking the maximum withholding tax right off the bat, you have an option. Non-residents who receive qualifying Canadian income can also apply to the CRA for a reduction to the non-resident tax required to be withheld by filing Form NR5. If the CRA approves your Form NR5, the approval usually covers a period of 5 tax years. However, there is a catch. If you receive this approval, you must file Section 217 income tax return for each year covered by the approval period. So timing is absolutely critical. A Section 217 election tax return must be filed with the CRA on or before June 30th of the year following the calendar year in which the income was received. Ensure you send it in on time, because if you do not file your Section 217 return by the due date, you will still owe the full amount of tax, and late filed elections may not be accepted. Managing your retirement accounts across borders is a massive financial transition, and doing it right requires careful planning and coordination. This is why I've decided to break this journey down step by step. In our next session, episode 3, I'm going to look at another massive financial hurdle, the departure tax and Form T1161. As a quick reminder, we have these sessions dropping bi-weekly into the Community Nomad platform and right here on this YouTube channel. We also host live Q&A sessions every week within the Community Nomad, so if you'd be interested in having your questions answered, please consider joining us. You can also submit your specific questions about RRSPs, RRIFs, or anything else we covered today in the comments below or directly in the community forum so that we might decide to address them in our next live Q&A. Drop your questions in the comments, plan accordingly, and I look forward to seeing you in the next live session. Before we get into the weeds, I want to address take 3. I am researching this cross-border tax information on my own so that I can Take 4. With a qualified professional before your specific situation. But what if even 15% is too high? What if your overall global income in a specific year is very low and you were still living, and if you were